Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, November 4th. The new month kicked off well for the technology stocks with an avalanche of fresh deal announcements among them, but for the rest, the picture remains mixed really and not necessarily as sunny. So we will talk about what could reverse this insatiable AI appetite and what would happen then. But before we do, please keep in mind that opinions are my own and this is not financial advice. So yes, ladies and gentlemen, the new week and the new month kicked off on a sweet note on the back of a renewed AI boost for technology companies. South Korean chip makers yesterday, remember, rallied in the very early hours of the new week and the new month following Nvidia's announcement last Friday that they will be selling 260,000 of their chips to a bunch of these South Korean companies and also to the South Korean government. The mood is less cheery this morning, but this is just, I think, a minor correction on the way. Nvidia, on the other hand, also gained 2% yesterday. Then Amazon also jumped 5% to a fresh all-time high level for the second session on an at least $38 billion deal with OpenAI for giving them access to hundreds of Nvidia chips as part of a 7-year deal. As such, Amazon became the latest company to seal a deal with the very OpenAI, which has been announcing these fresh deals with the sector giants since weeks, remember, to secure whatever computing power it can get from whom it can, and offering each of these companies on the way and their investors, of course, a moment of glory in the market. So far, OpenAI announced deals with, on top of Microsoft, obviously, that it has a partnership with, Oracle, Google, AMD, CoreWeave, Broadcom, and now Amazon. And elsewhere, Microsoft also announced a deal on its own with the Australian Iron, which actually used to be a crypto mining company, but upgraded its data center to rent out some of its computing power to its insatiable big tech companies. So Iron jumped more than 11% in Nasdaq yesterday. And another one of these mining companies, Cipher Mining, also jumped 22% yesterday on announcement of a $5 billion deal with Amazon. So the technology stocks had a nice Monday session and the continuation of these announcements of huge deals among the big technology companies, even though some skepticals out there continue to raise their eyebrows, growingly concerned actually by the circularity of these deals among these big technology names. But for now, investors are loving them. Elsewhere, European car makers was another pocket of the market that looked particularly good yesterday, as China signaled here that it would ease the export ban on an Xperia chips, following tensions that were sparked last month, remember, by the Dutch government's takeover of an Xperia from its Chinese owners over governance and security concerns that literally triggered a fresh diplomatic drama between the two blocs, between the European Union and China, and then prompting China to block the exports of these finished chips to European car makers, and hence disrupting the key supply chains here. So the easing of these restrictions yesterday actually came as a relief and triggered a relief rally across European car makers, pushing Volkswagen, for example, some 2.30% higher during the session. Renault, Mercedes, and Stellantis also gained yesterday. But note that gains in Europe were also on the menu for other sectors. So Rheinmetall, ASML, and big banks were also among the gainers yesterday. So the rally here was quite broad. That was not the case, however, for the US indices, where a set of weak ISM data from the US prevented the S&P 500 from extending its gains further and beyond the technology sector, because in fact 300 companies in the S&P 500 yesterday fell, and the S&P 500's equal index closed 0.24% down yesterday on worries that the US economic activity may be weakening right now, without, however, giving a guarantee that the Federal Reserve will be cutting the interest rates again in December. Indeed, the probability of another 25 basis point cut from the Fed in December has now eased to 65% from above 90% last week before the Fed decision. And Chicago Fed's Mr. Goolsbee rubbed salt in the wound yesterday, saying that he is now more concerned about inflation in the US than jobs. And even though some other Federal Reserve members sounded more dovish than Goolsbee did, well, the US 2-year yield, which best captures the Federal Reserve rate expectations, actually was up at yesterday's trading session, hinting that the Federal Reserve doves lost further ground yesterday, and despite the soft economic data and the US government shutdown story that should further weigh on US growth expectations. And well, higher US yields helped the US dollar further extend its gains against some of the majors here, including the pound and the Japanese yen. And that was exactly the contrary of what was expected to happen during a US government shutdown a few weeks ago. And this government shutdown, on top of it, is not a short one. It is actually, on the contrary, on track to become the longest one in US history this Thursday. But here we are, major US indices hold their ground even though the technology and AI related names continue to do the heavy lifting and bubble and circularity concerns keep bubbling. And the yields in the US are higher since last week, but they are still at the lowest level since the April dip, and the US dollar is recovering as well. Market volatility, on the other hand, remains quite contained, and earnings from the S&P 500 companies are coming in better than expected by analysts. Meanwhile, big technologies bond issuance is drawing exceptionally strong demand on both sides of the Atlantic Ocean right now. We are here talking about 5 to 10 times oversubscription for names like Oracle, Google, and Meta, as these companies are looking for more financing and investors are looking for more AI exposure through a different and arguably less risky financial instrument that are bonds. So what could go wrong, right? Well, many analysts bet that the rally in major global indices, as shouldered by AI and technology, will continue on the back of this insatiable AI appetite and endless deal announcements every other day in the sector, robust and better than expected earnings, and easing trade tensions with the United States. Plus, note that November and December tend to be seasonally strong months for stock investors. So if all goes according to the plan, the year could eventually end without another April-like sharp sell-off across the global financial markets. That is the base case scenario that is being put out in the market right now. But it's always good to remember, obviously, that the buzzy AI headlines continue to hide. They continue to mask some deteriorating reality underneath that if you take the technology out of the picture, the rest is not necessarily as sweet. And even inside technology, the valuations are very, very high right now, and the urge to see the return on investment on these AI investments is rising. And Bank of America, for example, predicts that AI capex will reach 94% of operating cash flow in 2026, up from 76% in 2024, and that's probably the reason why these companies are now out and issuing debt. And high valuations combined with falling cash flow levels mean that investors will grow pickier about the return on their AI investments, and the latest market reaction comes as a warning because Palantir yesterday became the third big technology AI related company after Microsoft and Meta last week that fell after announcing record and better than expected quarterly results. And the problem is, if the technology sneezes, the global financial markets, starting with the US, will catch a cold. So we will see what happens, but it's always good to keep risk in mind when investing, right? And on the macro front, despite the lack of fresh official data from the US, available data from private sources actually suggests slowing US economy and weakening US labor market because the US layoffs have already reached the highest level since 2020, according to some sources. Inflation risk persists, obviously, due to the US tariffs, and geopolitical and trade setup remains very, very unstable despite the latest deals, and developed markets politics and their budget discussions and their debt worries are not looking good either. So today, major US and European index futures are in the red at the time I'm talking here, but still there are no particularly worrying signs of stress, at least not for the moment. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.